I'm just recording the video as well. So all these are for equities and economics, right? Okay.
Yes, sir.
See, all the sums, what I would suggest is that, you put it into the group that I have formed,
Okay.
uh, so that, you can get answers from them itself. No? Because it is only sums. Theories, I will handle it because that needs explanation.
Okay, sir.
Sums point of view, uh, you ask them because that will give opportunities for others also to, have better practice, because they will also come to know like what kind of problems, others are facing, and then they will try there. Okay, and but still you are not convinced anywhere, you are always welcome to come back and ask. Okay.
Okay, sir.
Yeah. Now this is equities doubt, right? If
Yes, sir.
markets, you can see the question, right?
Yes, yes, sir.
Okay. If markets are semi-strong efficient, when passive portfolio manage, then passive portfolio management strategies are most likely to earn abnormal returns. 1 minute.
Because so what I thought in this, we cannot earn via fundamental and technical, right? But we can earn via private information. So I thought that way, but it was wrong.
Wait. If markets are semi-strong form efficient, then passive portfolio management strategies are most likely to uh, mm, if markets are semi-strong form efficient, uh, then passive portfolio management strategies are most likely to earn abnormal returns, outperform active trading strategies, then underperform active trading strategies. Okay, so here you selected A, so why not A? That is your doubt, correct?
Yeah.
See, if markets are semi-strong form, then passive management portfolio strategies are most likely to. Okay. Now, first of all, when you are okay, so in semi-strong form, by trading you cannot make abnormal returns. Why? Because one cannot make abnormal returns um, using the historical as well as fundamental data.
Fundamental.
Correct?
Yeah.
Using
Yeah.
historical and fundamental. So passive management strategies are most likely to. So in that case, um, so first one says earn abnormal returns. They are most likely to earn abnormal returns. They are most likely to outperform active trading strategies. Okay. Underperform. Okay. C will not come. That is sure
Yeah.
for
C
you.
will not. Yes, sir. C will
Okay.
not come.
Now, how will they earn abnormal returns? Only through private information.
Yeah.
Now, that is not given here because they
Yeah.
said passive portfolio.
Passive portfolio and semi-strong.
So that means A also
Yeah.
should not
Okay.
come now here,
Yeah. Okay. Got it.
because
Okay.
you can earn abnormal returns only by private or inside information. That is not mentioned
Info.
here because they said passive portfolio managements.
So if
So
the question would have been strong form efficient, so the answer would be earn abnormal returns, right?
no, in passive form, in strong form, you cannot
Strong
earn
form.
only. You cannot earn because everything is known to everybody.
Yeah, okay. Yes, okay. Useful, okay. Useful would be nothing then.
Ah,
Because it's already
yeah, you cannot.
incorporated
Yeah,
in the
yeah.
price.
Now
Okay, okay.
here in this one, outperform active trading strategies, because anyways in active trading strategies you cannot do much in semi-strong, because active trading strategy is what? Historical data.
Historical data, yeah.
So the one who is following passive, he will be better than the active trading strategies.
Okay,
You
okay, sir.
understood the reason? Because you cannot
Yes, sir.
beat using active trading strategies. So that means your performance will be poor. Why it will be poor? Because everybody will know it.
Yeah,
Okay. So
yes.
that's why then passive investment, that means you are just following fundamental that way.
Fundamental, Yes.
So that will be better then.
Okay, sir.
Okay. A is okay only for if they, if they mention that, using private information, then in a semi-strong form, you can make abnormal profit using private information or inside information.
Okay, sir. Got it.
The next one, technical analysts assume that markets are weak form efficient, weak form inefficient, and semi-strong form efficient. Technical analysts assume, see, if you are a technical analyst and if you are, let's say you are into what is weak form market efficient. See, weak
Okay.
form market efficient, the weak form market efficient, the characteristics is weak form market efficient. So what does the characteristics say in a weak form market efficient? The characteristic says that in a weak form market efficient, the characteristic says that one cannot make abnormal profit. One cannot make abnormal profit using one cannot make abnormal profit using
Technical analysis.
uh, one cannot make abnormal profit using technical analysis, correct?
Yeah.
That means everybody knows technical analysis there. Okay, now
Yeah.
here
It's
it
okay.
says
It's incorporated.
technical analysis assumes that markets are, but still if you are doing, what does that mean? That means you think it is inefficient. If you still do and make money, then the weak form market is inefficient
Insufficient. Okay.
because one cannot make abnormal profit. Let's say you are still making abnormal profit through technical analysis. That means for you the market is inefficient.
Inefficient. Okay, sir.
So here, so that means that's what your technical analyst will assume, that I will make abnormal profit. Okay, then that means for you the weak form is inefficient. It is not
Inefficient.
efficient because in an efficient market you cannot make abnormal profit. If you think you can make, then you believe the market is inefficient.
Inefficient. Okay,
So
sir.
that's why it is weak form inefficient. If it is weak form efficient, then technical analyst cannot make market abnormal profit.
Yes, sir.
Okay,
Rather, you
then
can
he will
use
not do, he will not
fundamental and private.
in weak form. Yes, yeah, yeah. And then semi-strong, technical analyst assumes that markets are semi-strong. No, technical
No, it
analyst will
cannot.
assume that
No, no.
weak form is inefficient. Then only you will
Inefficient.
try to make abnormal profit here.
Okay, sir. Yes, sir. This is
Yeah.
the same as previous because fundamental analyst assumes if we can make profit in semi-strong, then it's inefficient.
Fundamental analysts assume that markets are so fundamental analysts will say markets are semi-strong point of view, it is
Cannot
inefficient then.
inefficient. Yes, sir.
Okay, this one. Same logic here.
Yes, sir. Got it.
Which of the following market anomalies is inconsistent with weak form market efficiency? Market anomaly is inconsistent.
So, can you explain momentum patterns?
Momentum means certain time of the year what will happen, for weeks, months, certain stocks will keep going up. It is in momentum. Okay, as
Okay.
in like not necessarily it has to go like this only, it may go like this also.
Okay. So it will be
But
growing and growing.
yeah, so basically it is in momentum, it keeps going up. Okay,
Okay.
momentum. It may come down also, that is also possible. But when normally people pick the stocks which are going up and then they try to make money out of these momentum stocks which are continuously going up. Okay.
Okay.
Which of the following market anomalies is inconsistent with weak form market efficiency? Okay. Earning surprise and closed-ended fund discount. Now, trading based on historical momentum indicates that price pattern exists and can be exploited by using historical price information. A momentum trading strategy that produces abnormal returns contradicts the weak form of the efficient market hypothesis, which states that investors cannot earn abnormal returns on the basis of past trends in prices. Investors cannot earn abnormal returns on the basis of past trends in prices. Inconsistent. See, first of all, first and third are not related to related to technical analysis. See, they are asking about uh, inconsistent with weak form market
Weak form.
efficiency. So the topic is about weak form, and that is okay, inconsistent. Trading based on historical momentum indicates that price patterns exist. That indicates that price pattern exists and can be exploited by using historical price information. Can be exploited by using historical price information. Can be exploited by using historical price information. Mm. A momentum trading strategy that produces abnormal returns contradicts the weak form of the efficient market hypothesis, which states that investors cannot earn abnormal returns on the basis of past trend prices. Okay. Which of the following market is inconsistent? Okay. So what it means is, see, ideally, you should not make abnormal profit in weak form market efficiency.
Yes, sir.
Right. Using trends. But
Trends, yes.
momentum pattern is a trend which is not following that weak form market efficiency, and it is helping you to make money. That's why it is inconsistent. It is not consistent with weak form. First and third are not at all weak, not at all weak form. Those are all fundamentals.
Fundamentals, yes.
Okay, fundamental. That means semi-strong form.
Semi-strong.
Only the second one is related to weak form, and in this one it is inconsistent. Why? Because you can make good abnormal profit, and when you make it is considered as an anomaly.
Okay, sir.
It is an anomaly because second one is only talking about technical analysis. First and third is
Technical
not
analysis.
related to only technical analysis.
Yes, sir. So what do you mean by closed fund discount?
Closed end fund is trading at a discount. Okay, closed end fund is trading at a discount. Closed end fund means it's a mutual fund. So what they will do is they will pool money from the people. Okay,
Yeah.
and that money will be invested into various securities, but then it will have a maturity period, let's say 3 years. So for 3 years it will be, it will be invested, and this fund will be listed in the exchange. So people
Okay.
who want to exit within these 3 years, they will sell. Here they will sell, others will buy this.
Okay.
Okay, and this when it is, these units will be trading based on the intrinsic value of all all
Okay.
these securities. So here it is, if it is trading at discount, then you can make good profit then.
Yes, sir. Okay. So the price will change accordingly
Yeah,
as
it
per
is
NAV.
trading in the market, right? So it will change.
Okay, sir.
Okay. Observed overreactions in markets can be explained by an investor's degree of uh, observed overreaction can be explained by risk aversion, loss aversion, confidence in the market, loss aversion. Yeah. So overreaction, observed overreaction can be explained by an investor's degree of loss aversions. Okay. Why loss aversion? What do you mean by loss aversion?
The loss is greater than the gain, as in
Yeah, the emotional
emotional,
reaction
yeah,
towards loss is
reactions. Yes.
greater than the gain.
gain.
So that is a what overreactions, no? That is they have
But
this
overreaction can also affect confidence in the market, right?
investor's degree. Yeah, but here, okay, fine. Here they are speaking positively about confidence, investor's degree of confidence. Okay, see, observed overreactions in markets can be explained by investors. Okay, even if you think that way, the first impact is loss aversion. Because you have loss aversion behavior, then it is affecting your confidence.
Okay,
So
because
this
okay,
comes next second.
okay. So- so- Loss. Okay, sir.
Okay. Yeah. Like traditional finance models, the behavioral theory of loss aversion assumes that investors dislike risk. However, the dislike of risk in behavioral theory is assumed to be the dislike is assumed to be leptocotic, asymmetrical, and symmetrical and asymmetrical. The dislike of risk is asymmetrical. Why asymmetrical? See, like traditional finance model, the behavioral theory of loss aversion assumes that investors dislike risk. That dislike risk, however, it is asymmetrical. Why asymmetrical? Because um, we again tend to take risk if we are offered more returns.
Yes, sir.
Right now, for example, generally I will say it is not good to invest in a penny stock. But if I feel that someday penny stock can give me huge returns, then I might jump into penny stocks then.
Yes, sir.
Okay. So it is asymmetrical. It's not that we don't give equal importance to equally, to profit and loss. So we tend to give more importance to losses. Okay. The behavioral
Okay.
theory of loss aversion assumes that investors dislike risk. Yeah. However, the dislike of risk in behavioral theory is assumed to be asymmetrical because
We
we
feel
worry about
the
loss more.
losses more
More.
than our gain. Okay.
Yeah.
Okay, sir. Got it.
Okay. Just hold on. Just one minute. Okay. I'm just
Yes,
getting
sir.
your call.
Oh, okay.
Hello.
Yes, sir.
Ah. The behavioral bias in which investors tend to avoid realizing losses but rather seek to realize gains is best described as
So can you
mental
explain
accounting.
gambler's fallacy and disposition effect?
Yeah. See, gambler's fallacy means, say, for example, imagine first time you are tossing a coin, okay, head and tail. You are getting head. Second time also
Okay.
you are getting head. Third time also you are getting head. Now tell me, fourth time, what will you bet on then?
Head.
Okay, why so?
Because the three consecutive times I got head, right? So I think my instance would be again head.
That is only called as gambler's fallacy. Because this is your wrong thinking to say that it will come as head. Why? Because now you think neutrally, you are tossing a coin. There are only two
Okay.
sides, head and tail.
Yes.
What is
Yes.
the probability of getting each one?
50%.
So that means equal probability both.
Yeah.
And what is the connection between the first toss and the second toss? No connection. Both are
No
independent.
connection.
Na?
Yeah. Yes,
Then,
sir.
so how can you say here it was head, here it was head, here it was head? You can see the screen, right?
Yes, sir.
So how can you say fourth time also it will be head? Because there is no connection between first and
No
second,
connection between. Yes, sir.
second and third. But still, you thought that because all these are head, but they are unconnected. But you connected them and you said even fourth time is going to be head.
Head. Yes, sir.
This is gambler's fallacy. That means you think that that you are applying your certain logic, and then you are thinking that you are gambling now, saying it will be head. Whereas
Okay.
whereas that is wrong. Na? Your what you thought did not have any logic. This is what happens na? In gambling, in casino and
Gambling.
all. People will think that this number came up again and again. If I'm rotating something like that, imagine in
Yes, sir.
numbers, some number is coming. So again, I will think that only that is going to come. That is gambler's
Fallacy.
fallacy.
Okay, sir.
Disposition effect means you tend to um, disposition effect means you have some winning stocks and some losing stocks. Some stocks made good profits and some stocks has given you losses. Okay.
Okay.
Now, um, which one will you normal behavior is you will sell winning stocks and you will keep losing stocks. Why? Because you don't want, why you want to sell winning stocks and keep losing stocks? Whichever company has made profit, you will sell. And whichever company has made losses, no, you will not sell.
Why, sir?
Investors, why? Reason being, whichever company has made losses, you don't want to come out of loss.
Okay, I'm scared.
You always want to, come out of every stock in profit.
It's
That is the
like
mindset.
correlated to loss aversion also, right, sir? Because I think I'm scared of losses more than gains.
So when you are in losses, no, that time you don't want to come out only. Just 1 minute.
Yes, sir.
You will tend to become a long-term investor there. Okay, 1 minute, 1 minute.
Yeah.
Yeah, hello.
Yes, sir.
That is disposition effect. Okay.
Okay. Okay, so understood the question.
Hmm.
I read it. Yes, sir.
Okay. You can see the screen, right?
Yes, sir.
Huh. In a highly efficient market, unexpected positive news on your stock is announced to the public. After this announcement, the difference between the market value and the intrinsic value of the stock will most likely decrease, na? Because it is highly efficient. So it will reach to the intrinsic value very quickly.
So it
So,
will be incorporated
acha, here the
automatically.
answer is zero, they
Zero,
mentioned.
yes,
Okay.
sir.
It will remain zero. Okay. Yeah. Okay. That is also correct only. See. Yeah. The reason being it is highly efficient means you think about weak form, semi-strong, and that strong form. So when it is
Okay.
strong form, even the private or inside information has already been priced in. So that's why it is zero.
Okay.
That means, before it was even announced to the public, people understood that this is going to happen,
So,
and so accordingly, market
people,
priced it.
well, when they got to know, they bought the stock. So, the effect when the announcement was announced was zero, as in, it's like that.
Effect was zero because everybody knew that is going to happen.
New. Okay, sir.
So the market already priced it in.
Okay. So, sir, in strong efficient, I cannot make abnormal profit also, right?
Yes, you cannot make abnormal profit.
Okay.
Yeah. If you make, that means it is not strong for you. That
It's inefficient, strong
yeah, means
inefficient.
yeah.
Okay.
An observation that stocks with above average price to earning ratios have consistently underperformed uh, those with below average price to earning ratios. Least likely contradicts which form of market efficiency. Okay. The observation that stocks with above average price to earning ratios have consistently underperformed with those below average price to earning ratio is least likely contradicts which form of market efficiency. Just 1 minute. 1 minute. Hello.
Yes, sir.
Sorry. Yeah. Here, an observation that stocks with above average price to earning ratios have consistently underperformed those with below average price to earning ratio, least likely contradicts which form of market efficiency. Weak form. Weak form should be um, weak form, semi-strong form, and then strong form. You have selected strong form. They are saying weak form. Least likely contradicts. Huh. Because yeah, least likely contradicts which form? Because see, in a weak form, you fundamental using fundamental analysis, you can make abnormal profit. Now,
Yes,
what
sir.
they have mentioned is fundamental one.
Yeah.
So
Okay.
that means
Okay.
it is
Okay.
correct
Price to
only.
earnings.
No? It
Yes.
is
Yes.
correct that in weak form they will make abnormal profit. That means it is least likely a contradiction. That means most
Like
likely
they
a
will make it.
possibility. Yeah,
They will
most
make
likely the
abnormal.
possibility that
Okay.
in a weak form they will make abnormal profit.
Okay.
Fine,
Got
right?
it, sir.
Okay.
Yes. Yes, sir. Got it.
Which of the following statement is most accurate in an efficient market? Security markets prices fully reflect their fundamental values. Active strategies will lead to excess risk adjusted portfolio returns. Securities market price respond over time to changes in economic information. Securities market prices fully reflect their fundamental values.
So C I've selected. It will be inefficient, right? A is perfect. The I understood the reasoning
Hmm.
because most efficient would be all prices like the technical, fundamental, and private information will reflect in the prices already.
Which of the following statement is most accurate in an see market is efficient. If market is efficient, it will fully reflect the fundamental value. Active strategies
Fundamental.
will lead to excess risk adjusted. No, fully efficient means there is nothing extra you can do here. Okay, here second one says will lead to excess risk adjusted portfolio. Active, no. Securities market price respond over time to changes. That means they will take more time. Why will it take more
No,
time when it is efficient? Securities
efficient.
market
Yes.
fully
Okay.
reflect their fundamental value.
Yes, sir.
Yeah.
Got it. Okay.
You just have to read this multiple times,
Yes,
and,
sir.
and then it will be fine. Then an internal evolution of the trading behavior of three fund managers of a mutual fund company during the past year has revealed the following. Uh, okay. Which of the three managers most likely displayed the disposition effect? Okay, disposition effect. I told you right that you are selling your winning portfolio and keeping your losing portfolio.
Super follow.
Okay.
Okay.
An
Yeah.
internal evolution of the trading behavior of the three fund managers of a company during the past year has revealed the following: was slower than peers when reacting managers to changes in information, rarely realized investment losses, but manager realized most of the gains. This is
Yeah.
B.
Most of the
This
day.
one.
Yes.
This
Yes.
one should be
Got
the
it.
one.
Yeah.
This one. This line. Yeah, this one. Arbitrage activity will most likely be higher in securities market that are inefficient. Only if it is efficient, how can you have with no uh, restrictions on short selling? Arbitrage activity will most likely be higher in securities where there are no
B.
restrictions.
No
High
restrictions.
information acquisition cost. Okay. With no restrictions on short selling, because then only
Then only
price it will be
arbitrage profit
mispriced.
will be.
So
Yes,
when
sir.
it will be mispriced, it may be mispriced on the higher side, it may be mispriced on the lower side.
On
That
lower
means it
side
may be
also.
undervalued, it may be overvalued.
Overall, yeah.
So when it is overvalued, short selling will happen.
Yeah.
Okay, whereas you have ticked what this one with high
See,
information
yeah.
acquisition cost. Arbitrage activity will most likely be higher in securities market with high information acquisition cost. No, no, no. Because if information acquisition cost is there, then less people will trade. If less
Yes,
people
people.
will
Yeah.
trade, then that will not then arbitrage will not happen. More people has to
Okay.
take place, then only arbitrage, then only the arbitrage activity will most likely be higher
Higher.
in
Okay.
securities market. No, yeah, this is not perfect one. No restrictions on short selling, because then only they will come and immediately trade, and then they will take advantage of the arbitrage.
Arbitrage. Okay, sir. Got it.
After the public announcement of the merger of two firms, an investor makes abnormal returns by going long on the target firm and short on the acquiring firm. This most likely violates which form of market efficiency? After the public announcement of the merger of two firms, an investor makes abnormal profit. That means if once it is announced, you cannot make abnormal profit if the market is semi-strong efficient. Because I'm
Because the
speaking
price is
about,
incorporated. Okay.
because I'm speaking about here fundamental. So semi-strong by going long on the firm and short. But here he is making abnormal profit. That means he is violating which form of market efficiency? Semi-strong and strong form also he is violating then. Because I
So can you
violating means he considers that as inefficient.
okay.
Semi-strong form inefficient. He is not violating weak form, no, because weak form wise you can make abnormal profit using fundamental.
Fundamental, yes. Okay. After the public announcement. Okay, sir. Got it. So I think from here, I think equity starts.
Okay. All of the following are characteristics. Okay,
Overview
it
starts
is.
next chapter.
Mm-hmm. Okay. Okay, I'll do one thing then. Okay, anyways, this is equities, right? Okay. All of the following are characteristics of preference shares except they are either callable or puttable. Preference shares can be callable, redeemable, uh,
Yeah.
redeemable and irredeemable. Wait. They are either callable except they generally do not have voting rights. They do not share in the operating performance of the company. Yeah, they are either callable or puttable. That is equity shares. This is redeemable, irredeemable, and convertible, non-convertible. Convertible, non-convertible. See, types of preference shares are what? Callable, convertible, non-convertible. You want me to write that one? Preferences.
Yes, sir.
Types of preferences are convertible and non-convertible. Callable and uh, no, convertible, non-convertible, redeemable and irredeemable. That is similar to
So
callable only.
callable and
Redeemable,
puttable would be in equities.
equity. Yeah,
Okay.
this
Not in preference. Okay.
redeemable, then participating and non-participating.
Cumulative,
Yeah.
not cumulative. Right?
Okay. Okay. I'll move to the next one.
Yes, sir. So preferences do not have voting rights as well, right?
Yeah, they don't have voting
So
rights.
the last slide, can you just uh, click on that?
Hmm.
I have selected this generally do not have voting
Except
rights.
it
So
says except.
okay. Except okay. So
So
these two
B
would
and
be
C are correct.
technically correct.
B
Okay.
and C are correct. features.
Okay, sir.
A is not the right feature.
Okay, sir. Got it. Emerging market. Well, so
Emerging markets have benefited from recent trends in international market. Which of this has not been a benefit of this trend? Emerging market companies do not have to worry about a lack of liquidity in their home equity market. Obviously, this is not been a benefit. Emerging market companies have benefited from the stability of foreign exchange market. Emerging market companies A, B, C, right? Okay. Emerging market companies have found it easier to raise capital in the markets of developed one. So this is a benefit. The question is not a benefit. Emerging market companies have benefited from the stability of foreign exchange. That is also good only. So first one says emerging market do not have to worry about lack of liquidity. Yeah. What is the problem here? These two are benefits. Good. These two are
yeah.
positive points.
So
Achha,
why
so
did C, sir?
emerging market companies have benefited from the stability of foreign exchange markets. The way they are writing it is like highly these options. They're saying this is
Confusing,
the
sir.
right
Sometimes.
one. Okay, this is the right one. This is the right one. A, B, C. In between, they are
Yeah.
including right answers.
Right
A, B,
answer. Yes,
C,
sir.
and they are saying this C is the right answer. A and B are wrong answers. Emerging markets have benefited from recent trends in international markets. Which of the following has not been a benefit? That means A and B are not a benefit, and C is the benefit. Emerging market companies have benefited from the stability. Yeah. Emerging market companies have found it easier to raise capital in the markets of developed countries. Okay. Emerging market companies do not have to worry about a lack of liquidity. Now, what is the problem in this question?
So I also don't know. They are telling C the correct answer.
No, see, emerging markets have benefited from recent trends in international markets. Which of the following has not been a benefit of this trend? So, first
Yeah.
one says emerging market companies do not have to worry about a lack of liquidity in their home equity. Now, imagine India is an emerging market. Okay. Now, if I say India don't have to worry about lack of liquidity in their home equity market, that means if equity market is not very good, then it is something to be worried about.
Very there. Yeah.
Okay, so they are asking which of the following has not been a benefit. Okay, which of the following has not been a benefit? The trends in emerging markets have not led to stability of foreign exchange markets. Have not led to the stability of foreign exchange market. Which of the following has not been a benefit of this trend? Which of the following has not been a benefit of this trend? Emerging market companies have benefited from the stability of foreign exchange markets.
So can you elaborate the C option?
Yeah, I'm not able to get like how the format itself is looking very dirty. It's like clumsy. It
Yeah.
looks very
Yes, sir.
clumsy. The C
Previous
one, previous
years
one
were
was much
okay.
better. Yeah.
Yeah, oh, much better.
Emerging markets have benefited from recent trends in international markets. Emerging markets have benefited from recent trends in international market. Which of this has not been a benefit of this trend? Emerging market companies do not have to worry about lack of liquidity in their home equity. This is not correct. Then B comes emerging market companies have found it easier to raise capital in the market of developed countries. Emerging market companies have found it
So
easier.
so this is B is the benefit, right?
Yeah, emerging market companies have found it easier, but then it will not be that easy as well in the markets of developed countries. You cannot easily go and take money from the developed countries. So this is not a benefit. Okay, B is not a benefit. Then comes A and C. So C says emerging market companies have benefited from the stability of foreign exchange market. This is possible, but this only they have taken as the answer. Then why A? Emerging market companies do not have to worry. Which of the following has not been a benefit? So this will not come. C, see the in between they are adding and confusing highly. Emerging market companies have found it easier to raise capital. No. So this is also a wrong statement. This is also a wrong statement. Emerging market companies have benefited. This is the right statement. But the question is which of the following has not been a benefit?
Not be benefit, yeah.
Okay. The trends in emerging markets have not led to the stability of foreign exchange market. The trends in emerging market emerging markets have benefited from recent trends in international markets. Which of the following has not been a benefit of these trends? Emerging market companies do not have to worry about a lack of liquidity in their home equity markets. The trend in emerging market have not led to the stability of foreign exchange market. Emerging markets have benefited from recent trends in international market. Which of the following has not been a benefit of these trends? Emerging markets have benefited from recent trends in international market. Which of the following has not been a benefit? Do not have to worry about lack of liquidity. Emerging market companies have benefited from the stability of foreign exchange market. Emerging, which of the following has not been a benefit? They are saying emerging market companies have benefited from the stability. The
Yes,
trends in emerging market have
contradicting their
not
own
led to the stability of
question.
foreign exchange market. The trends in emerging market have not led to the stability of foreign exchange markets. Emerging market companies have benefited from the stability of foreign exchange markets. Okay, so that statement is wrong then. If that statement is wrong, even other statements are not wrong only. Emerging market companies do not have to worry about lack of liquidity. That is also wrong only.
Yeah, they have
Then,
to worry.
yeah, this is all questions problem only. Skip this
Okay,
question.
sir.
There is something wrong in the articulations.
Okay, sir.
This question now, right?
No, sir. This is done. This is also done, sir.
This one, this one is also done. Okay.
This is,
This
yeah.
one now, right? With respect to level 3 sponsored areas, which are the following is least likely to be accurate? They, again, like the format is very disturbing. A, B, C, and then again A.
Yes, sir. So they
With
have
respect,
created an app. So if I don't need to log in.
okay,
I
okay.
just need
Just,
to
yeah,
go to the app and
just 1 minute.
yes, sir.
Hello.
Yes, sir.
Okay. Huh. Level 3 sponsored areas, which are the following is least likely to be accurate? They have low listing fees. They are traded on the NYSE, NASDAQ, and MX. Then they are used to raise equity capital in US market. They have low listing fees. Least likely to be accurate. Okay, least likely. So they are traded on because these are all listed only. So they are traded here. So B will
Okay.
not come. C is they are used to raise equity capital in US market, and that is also fine. Low listing fees, so listing fees are high. So here it is
Hi.
very
Okay.
clear, right?
Because it's least likely.
Yeah,
So most likely would be C, right?
most likely is B and C.
B and C. Okay. Okay.
Which of the following statement is most accurate in describing a company's book value? Book value increases when a company retains net income, and that is right only. Okay. Then book value is usually equal to the company's market value. That is wrong. The ultimate goal of management is to maximize book value. No, that is also not correct.
Why,
So
sir?
that's why the ultimate goal is not to keep increasing the book value, but to keep making the profits, no, for the company.
Okay, sir. Okay. But
The
sir,
first one,
it will be
see, first one,
reflected, right, in their
yeah,
book
yeah,
value.
yeah. The first one is net income. The priority is net income, right? Because of net income, book value is going.
Okay. Directly proportional.
Hmm.
Okay, sir. Got it.
So between book value and net income is the first priority.
Okay, sir.
A company's cost of equity is often used as a proxy for investors. A company's cost of equity is often used as a proxy for investors. Um, Average required rate of return, minimum required rate of return,
So can you
maximum
explain
required
the
rate of return.
question?
Cost of equity is often used as a proxy for investors. That means cost of equity means, say for example, cost of equity using CAPM, you are finding cost of equity for Indigo is, let's say 13 percentage.
Okay.
So if it is 13%, that means they have to, the returns that they are creating should be easily, it should be at least 30 percentage.
Okay.
So
So
that
my
means the
required return.
minimum required rate of return is 30 percentage,
So
30
my
percentage.
required return would be their cost because they have to repay.
Yes, yes,
Okay.
yes. A company has only one class of common shares and it does not pay dividend on them. It has also issued two types of non-cumulative preference shares, one that is puttable and the other callable. Which of these securities most likely after the lowest expected return to the investor? Uh, Common shares, puttable preference shares, callable preference shares, puttable preference shares. The question is, a company has issued only one class of common shares. A company has issued only one class of common shares and it does not pay dividends on them. A, a company has issued only one class of common shares. Okay. And it does not pay dividends on them. It has also issued two types of non-cumulative preference shares. One is puttable and the other is callable. Which of these securities will most likely offer the lowest expected return to the investors? Common shares. See, callable, they may give high returns. Puttable, they will not give high returns because that is already a benefit for the investors.
Investors. Okay.
Okay. So, the question is which of them offer the lowest expected? So, lowest is puttable.
Putable.
So
Okay,
that's why
sir.
it is puttable because it's already giving a benefit to the investor. Right? They
Okay.
have the right to sell it back. No?
Exercise. Yes. Okay, sir.
Then preference shares are less risky than common shares because preference shares have fixed dividend. Yeah, guaranteed return. It is not guaranteed if your company is liquidated.
So
If it is
fixed dividend
liquidated,
would be if the company announces dividend, right?
yeah. But whenever they announce dividend, the rate is fixed.
Okay, the rate is okay. Fixed. Okay.
Guaranteed return if a company is liquidated. Preference shares are less risky than common shares because preference shares have mm,
Because the preference shares will get guaranteed return, like debt, then preference, then equity.
a guaranteed return if a company is liquidated. Okay, what is the doubt here?
So I selected B.
Guaranteed return if a company is liquidated.
I
No,
thought because
how can they give return if it is liquidated?
I thought by selling assets,
Although, how can you guarantee? The value of
no,
the assets might have gone up,
differ.
down.
Yeah, yeah, it can differ. But I thought the debt would be paid first, then the preference, and then the equity.
Hmm.
I thought in that way.
Mm-hmm. Okay, this is okay now. This is okay.
Yes, sir. Okay.
Convertible preference shares are popular in financing venture and equity, are subject to more price volatility than the underlying. Convertible preference shares are more price volatility than the underlying common shares. No, those are not more volatile. Are popular in financing venture capital. Convertible, no. Then do not increase in value due to an increase in price of the underlying common shares. Convertible common shares are popular in financing venture capital and private equity. Convertible preference shares are popular, subject to price volatility. B we can eliminate.
Yes, sir.
C1 do not increase in value due to an increase in price of the underlying.
Because if equity shares increase, I will exercise because it's convertible.
Do not increase in value due to an increase in price of the underlying common shares. Do not increase in value due to an increase in price. The convertible preference shares, you can convert it into equities. So its value will go up. You can convert it into equities. Do not increase in value due to an increase in price of the underlying common shares. Convertible preference shares allow investors to benefit from a rise in the price of the common shares through the conversion options.
So they are
Do
not
not
giving the
increase in
reasoning
value.
for correct. They are
Yeah, yeah.
giving reasoning for incorrect.
Do not increase in value due to an increase in price of the underlying common shares. Do not increase in value due to increase in the price of the underlying common shares. This is doubtful only. Convertible preference shares allow investors to benefit from a rise in the price of the common shares through conversion. Yeah, so automatically do not increase in value due to an increase in the price of the underlying.
So, sir, if it's
It will
convertible,
increase. It will
uh,
increase. The options value will increase.
because it's convertible.
Yeah, because the demand for preference shares will go up
Okay.
because
So,
they
sir,
can convert it into equity. So this is correct only.
C and B is eliminated.
In
C.
fact, this should be wrong here. Are popular in financing venture capital and private equity, because why will they convertible? Because then who will give them fixed uh, dividends all the time?
Yeah, fixed dividend. Okay, yeah.
This is doubtful.
They said are popular in financing venture capital and private equity transactions.
Yeah, this is doubtful question only. You
Okay,
may
sir.
check this in curriculum if you want, or if you skip also this kind of too dicey question also, it is fine. Because I don't think this is the answer. This should be the one. Even here, this also looks partially only, because more popular in financing. It may be popular because it is convertible, but it is also not popular because it is preference shares. Because in preference shares, then fixed dividend also they will have to give, which will be a burden on the company, the
Company.
new company. I doubt again. This is a doubtful question. You
Okay,
can
sir.
skip this one also. Okay. Or I have to check this one, but it's not very convincing the way they have written.
Yes, sir.
Something is
So
not
they
convincing.
generally provide for incorrect answer, explanation for incorrect. They
Mm.
do not provide for correct
Yeah, yeah,
explanation.
and the format is also not looking good only.
Yes,
I
sir.
changed this year. Okay, okay, fine. See, what I'll do is I'll stop now here. Evening, then evening, evening. I'm not sure if I'll get time.